everybody, welcome. Today is May 9 already. A lot of economic developments over the past month that I want to share with you. If you have a question as we go through the material today, there is a question box on the right-hand side of this GoToWebinar platform that we're using. So if you go ahead and type it in there, both Mark and I will be watching for those as we go through the material today. So that said, let me go ahead and jump in. The headlines I want to talk about this week: stocks are continuing their decline. Used car prices are now falling. So the question is, have they peaked? Is stagflation here? I want to give you a perspective on recession. It's my belief that we are now in recession. There are many analysts that would disagree with me. And is liquidity addiction the reason the markets are falling? So let me start just talking about stocks. This is from Bloomberg, and the headline is the Standard & Poor's, the S&P, suffers the longest weekly losing streak in a decade. So stocks are not doing well. Volatility continued to dominate financial markets. Stocks pushed lower as the latest U.S. jobs data cemented expectations the Federal Reserve will remain on its rate hike path to combat stubbornly high inflation. At the end of a week marked by fickle trading, quick reversals, and heightened anxiety, the S&P 500 failed to stay in the green. It failed to post a positive week, and it fell to its lowest level in about a year. Lindsay Bell is quoted in the article. Lindsay is chief market and money strategist at Ally. Lindsay said the markets have been on a roller coaster ride. There's a significant amount of uncertainty. A key question for many investors is how big of a hurdle a quickly rising interest rate environment is going to be for stocks to overcome. I will tell you that I believe they will not be able to overcome it, and I believe a rapidly increasing interest rate environment will ultimately throw the economy into recession. And I'm going to show you some evidence that I believe indicates that we are maybe headed in that direction. This chart is a chart of stocks. It's a chart of the S&P 500. This comes from a program that I use to track stocks called TradeStation. And it allows me to manipulate charts to add indicators, to build my own indicators. And you see that I've drawn on this chart, which is incidentally a weekly chart. So this weekly chart is in Japanese candlestick style. What that means is every one of those bars on the chart represents 1 week of price action. The red bars on the chart represent weeks the market declined, and by market I'm referring to the S&P 500. The green bars on the chart represent weeks that the market advanced. Now I've drawn from the bottom left to the top right a trend line in blue, and you see that from the market bottom really in March of 2020, stocks went straight up through the end of last year, through December of 2021. Then you see that trend line was broken to the downside, and now there is a trend line. If you were to draw it from the peak, you have a trend line now moving down. And you see we have this stair-step pattern now beginning to form of lower highs and lower lows. So that tells me that I believe there is a fairly high probability that the market decline continues, but markets typically never go straight up or straight down. There's typically a stair-step type movement, and I expect that this will be in that vein as well. Now, used car prices are starting to fall. This article from CNBC says it's easing the impact of inflation. And I've for a long time talked about the fact that we're going to see likely inflation followed by deflation. I talk about this more in this week's Portfolio Watch. Used car prices are now starting to deflate a bit. Cox Automotive said on Friday that its Mannheim Used Vehicle Value Index, which tracks prices of used vehicles sold at the U.S. wholesale auctions, declined 1% in April from March. Wholesale vehicle prices have dropped 6.4% from the January record high, but the index is still up 14% year over year. So we're just starting to potentially see a reversal. This is from the body of the article. Wholesale used vehicle prices have notably fallen from a record high set in January, signaling the worst of sky-high prices related to higher inflation in the U.S. might be behind us. We saw the Mannheim Used Vehicle Index decline 1% in April from March. That's the third straight month that used vehicle prices have declined. Jonathan Smoke, who is an economist at Cox Automotive, was interviewed for this article. Mr. Smoke said that we have clearly returned to vehicles depreciating again. That's good news for consumers looking to buy a vehicle. And again, it points out that from the January record high, prices are down 6.4%. However, they're up 14% from a year ago. Used retail sales of cars declined 13% in April from March, suggesting demand is easing amid the record high prices. Now, I want to give you a different perspective on this. I think that when you put this in context of everything else going on in the economy, you've got inflation that is consuming the discretionary income of a lot of consumers that might otherwise be in the automobile market. And I've got some statistics I'll share with you in a minute that will validate that, I believe. But when you see a decline in vehicle sales, 13% from one month to the next, there's a reason for that. And I believe the reason for that is that the general everyday living expenses are now a lot more expensive for a great percentage of the population. That means it's prohibitive to buy a car at this point. Now, if you take a look at this Mannheim Used Vehicle Index value, you see that the starting point is 100 from the mid-1990s. It stayed at 100 through 2010. It didn't increase much at all, maybe to like 125 or so in 2020. And then the Fed opened the floodgates of currency creation, and we saw that number jump by about 40%. To think that used car prices went up 40% in about 2 years, less than 2 years actually, is certainly something that we can all agree is not sustainable. And that chart pattern goes parabolic. It goes almost straight up on the right-hand side of the chart. Now you can see it's starting to fall, and I would expect that it's going to continue to fall as time passes. So if you're in the market for a used vehicle, my crystal ball doesn't work all the time like everybody else's, but you might think about waiting a little bit. Automakers for more than a year now have been battling through a semiconductor chip shortage that has sporadically halted production of new vehicles, causing record low inventories of vehicles and higher prices. The shortage of the semiconductor chips have pushed a lot of otherwise new car buyers into the used car market, creating demand there. Smoke, the economist that we mentioned earlier, said that he expects prices to remain elevated but return to fairly normal patterns, with the potential for a few modest price increases later in the year. No, as I would completely agree with that. It's potentially becoming a bit deflationary in that regard, and that's my point in talking to you about this today. Adding that it doesn't necessarily mean there's going to be a massive price correction. This is not a commodity market that people are speculating, and used vehicle are assets that actually provide utility to folks. We had an unusual circumstance over the last 2 years that stimulated demand, and we have limited supply. Such declines are good news for the Biden administration, which blamed much of the rising inflation rates in the country on the used vehicle market. In the past 20 years, used cars' contribution to inflation averaged 0. In January, it contributed more than 1% on a year-over-year basis. So it's a factor, but not a significant factor. Which brings me nicely to my next topic, where we're talking about stagflation. And again, if you have a question, type it in the question box on the right. Mark will also alert me if there's a question somebody has that maybe I don't notice right away. So this article written by Aaron Prater is titled, "What is Stagflation? Fears are rising that the U.S. economy is headed for a 1970s style death spiral." Pretty ominous headline. Consumer inflation is up more than at any time since the 70s. And the article talks about the fact that a lot of folks are worrying that this is reminiscent of the 1970s. Now, I'll talk to you in a moment that I believe it's a bit different than the 70s because debt levels today are so much higher than they were in the 1970s. But the average person is waking up to stagflation because Google searches for the term stagflation are quadruple what they were just a couple weeks ago. So everybody wants to know, what is stagflation? Well, you probably all know this. It's a combination of a shrinking economy, a recession essentially, and high inflation. Now, there is an economist in this article, Veronica Dolar, who is an economist at State University in New York. And she said that GDP, or the total output of all goods and services produced, shows us what the broader economy is doing. Unemployment tells us about the job situation, and inflation measures the movement of prices. She said the stories also overlap, but they don't all tell us good news at the same time. So she notes that you might see a strong economy with low unemployment countered by higher inflation. Maybe you've got lower inflation with lower economic output and perhaps higher unemployment. She said, so often there's good news, bad news. It's a good news, bad news situation. We've got low inflation, low economic growth. We've got strong employment, but higher inflation. With stagflation, you don't get any good news. You've got a shrinking economy and higher consumer prices. So that resembles a lot the economic situation in which we found ourselves in the 1970s. Energy prices went up, not unlike what we've seen today. There was an embargo led by OPEC from 73 to 75 that actually, as those of you who have been participating in the Headline Roundup webinars know for a long time, know, that's related largely to the establishment of the petrodollar at the time as well. We saw the same thing happen in 78, 79. And essentially, we had a shrinking economy and we had high inflation. Of course, the politicians of the day reacted by putting in place price controls. And as the article points out, in 1974, President Richard Nixon signed a law known as the Emergency Highway Energy Conservation Act. This made the national speed limit 55 miles an hour. It stayed that rate for 21 years until 1995. Now, the article says we're not there yet. And this article is a few weeks old. Bloomberg noted the world economy has a decent shot at escaping a full rerun of the 70s-style stagflation, but that's about as far as the good news goes. Now, my take is that we're going to move to the deflationary environment after the stagflationary environment, as I talk about in this week's Portfolio Watch, simply because there's too much debt to grow out of. With a shrinking economy and debt levels, we have to see a deflationary environment. So I think we're seeing inflation, we're starting to see deflation emerge, and it's never a clear-cut, well-defined transition from inflation to deflation. You start to see symbols of both for a while, and this can go on for a very long time. Now, Peter Grandich commented on this. For those of you not familiar with Peter Grandich, he is a frequent market commentator. He is the founder of a company called Peter Grandich and Company. And he points out that inflation today, compared to what we saw in the 70s and 80s, is a completely different animal. And I would certainly agree. He said, and the situation is so beyond what the Fed can do now. He said the enthusiasm over this week's Fed rate hike is misrepresentative. He said the Fed is still behind the curve and needs to be more aggressive. And I certainly agree with Mr. Grandich here. I have said that we need to have real positive interest rates. In other words, interest rates higher than the inflation rate in order to get inflation under control. And we're not even close to that yet. Now, Grandich makes another interesting observation. And here's his quote: "Social and political disharmony is at the highest level since the onset of the Civil War in the U.S., and with the world suffering economic challenges, it does not paint a good picture for the future," he warns. General stocks and bonds have had a phenomenal run, but he said they're overdone on the upside. I mean, with interest rates at zero, bonds can't do anymore. And we've talked about the Buffett indicator, which measures the valuation of stocks compared to economic output. And they both, as we have stated, are overdone. And we're starting to see that correct. He said, the only market I can risk capital on for capital appreciation is the gold market. He concludes that mining companies, especially the majors are those companies that are producing gold. The miners are those exploratory companies, or the juniors, as they're sometimes known, are the exploratory companies. So he says the majors, the producers, are in phenomenal shape. Now, as it relates to recession, I think there's a lot of signs that we are seeing recession. Deutsche Bank warned this past week that a major recession is coming. And again, if you have a question, and Mark, I'm not seeing any at this point, but I'm assuming you'll interrupt me if there is a question, please go ahead and type it in the question box on the right-hand side of your screen. So Deutsche Bank, this is from CNN Business, raised eyebrows earlier this month by becoming the first major bank to forecast a U.S. recession, albeit a mild one. Now it's warning of a deeper downturn caused by the Federal Reserve's quest to knock down stubbornly high inflation. Deutsche Bank economists wrote in a report to clients last week that we will get a major recession. The article is a bit contradictory, first talking about a mild recession and then a major recession. The bank said that inflation may be peaking. I think the jury is still out on that. And the bank said it's going to take a long time before it gets back down to the Fed's goal of 2%. That suggests, according to Deutsche Bank, that the central bank will raise interest rates so aggressively that it hurts the economy. Now, I think that as I talk about in this week's Portfolio Watch, there is three potential outcomes at this point, one being stagflation, which near term I believe is the most likely. But I believe that if you start to see the economy soften, if you start to see stocks and real estate react negatively, there's a real risk that the Fed reverses course. I've interviewed a lot of people on this topic, and the jury is out on this. Deutsche Bank, its economists, I should say, wrote why the coming recession will be worse than expected. Quote, we regard it as highly likely that the Fed will have to step on the brakes even more firmly, and a deep recession will be needed to bring inflation to heel. Certainly, I agree with that. The best cure for inflation is a deflationary collapse. You have to remember that the reason that currency is created in the first place is because debt excesses have gotten to extreme levels. And when the inflation stops, the debt is still there and the deflation still has to kick in. Consumer prices up 8.5% in March. That is the highly manipulated official inflation number. The jobs market remains on fire. Moody's Analytics projected the unemployment rate will soon fall to the lowest level since the early 1950s. That is, of course, also a heavily manipulated rate, but there's certainly plenty of jobs out there and many employers that can't fill positions. Deutsche Bank created an index that tracks the distance between inflation and unemployment over the past 60 years and the Fed's stated goal for those metrics. That research, according to the bank, finds that the Fed today is much further behind the curve than it has been since the early 1980s, which simply means that they may not be able to get inflation under control near term, which is why I believe we're going to see stagflation. History shows the Fed has never been able to correct even smaller overshoots of inflation and unemployment without pushing the economy into a significant recession. Given that the job market has over-tightened by as much as 2 percentage points of unemployment, the bank said, something stronger than a mild recession is going to be needed to do the job. That talks about the deflationary environment that always follows the inflationary environment. Now, Goldman Sachs has a differing view. Deutsche Bank is pessimistic. Goldman Sachs says it will be very challenging, quote, to bring down high inflation and wage growth. But Goldman says a recession is not inevitable. They say, quote, we do not need a recession, but probably do need growth to slow to a somewhat below potential pace, a path that raises recession risk. That is a very narrow path. The path that Goldman is talking about here is often referred to as a soft landing. Can the Fed bring inflation under control and not crash the economy? Can they achieve a soft landing? I believe they cannot. Many of the guests I interview also believe they cannot. Goldman is stating that yes, maybe they can. And finally this month, this is nothing but shocking to me. When you take a look at consumer credit numbers, when you take a look at how credit card debt has grown in just 1 month, it's alarming. The article, this is from Zero Hedge, says that while it is traditionally viewed as a B-grade indicator, the March consumer credit report from the Federal Reserve was an absolute shock and confirmed what we have been saying for months. Any excess savings accumulated by the U.S. middle class are gone, and in their place, Americans have unleashed a credit card-fueled spending spree. Just take a look at the numbers I'm going to share with you. These are total consumer credit numbers. You see the chart there. The article says here are the shocking numbers. In March, 1 month after the February print already came in more than double the 18 billion expected, consumer credit exploded to an absolutely blowout of $52 billion, again, more than double the expected 25 billion, the highest on record. So take a look at total consumer credit, and this goes all the way back to 1990. So if you take a look at this chart on the left-hand side, it goes all the way back to 1990. So for more than 30 years, take a look at consumer debt levels, consumer credit. They're at highs that are more than twice what they were over prior highs. What does that tell you? It tells me that inflation is taking its toll. Consumers are turning to credit cards to make ends meet. The article continues, and while non-revolving credit, which would be student and car loans, rose by a relatively pedestrian 21 billion, which was still the 6th highest on record. If you take a look, still pretty high. The real stunner was credit card debt. This is revolving debt. Credit card debt, get this, more than doubled from February to March. Credit card debt went from 14.2 billion to 31.4 billion in 1 month. So take a look at that chart. You can see that this is, if you'll excuse the expression, literally off the charts. The article makes a really good point. These high credit card debt levels have been achieved or obtained, I guess you should say, just in time for interest rates to start moving higher, first slowly and then very fast. This is going to bury a lot of consumers. You have to remember when we're talking about recession here that the consumer credit-driven economy in the U.S. is dependent on consumers going out and spending money. If consumers don't have spending capacity, the U.S. economy suffers, and the U.S. economy is more than 70% dependent on consumer spending. So here we saw in 1 month, credit card debt go from 14 billion to 31 billion. That's staggering when you think about it. While this unprecedented rush to buy everything on credit at a time when there were no notable hallmark holidays should not come as much of a surprise. After all, we have repeatedly shown that for the middle class, any excess savings are now gone, long gone. The fact is that most economists, such as those at Goldman Sachs, had previously anticipated that continued spending of savings by consumers who they fail to realize are now tapped out, is what will keep the U.S. economy levitating in 2022. See, if there's no savings and you've got your credit cards tapped out, consumer spending will slow, and that's bad news for the economy. And that's why I believe that we are likely now in a recession, and believe that as the numbers are revised moving ahead, that it will demonstrate that we are in a recession, and that's my opinion. Unfortunately, back to the article, as today's consumer credit numbers clearly demonstrate, any savings that the middle class households may have stored away courtesy of stimmies are long, long gone. And the implications are profound. Any model that projected U.S. spending will be fueled by savings can now be trashed. And since this is most of them, the consequences are dire as they confirm once again that the Fed is tapering, quantitative tightening, and hiking interest rates right into a consumer-driven recession, which was not visible until now because of the credit card-fueled spending, which we're now seeing. So I believe for those reasons that we are moving into a recession, and I believe that the Fed will likely have to reverse course. Now, we'll have to wait and see how this plays out, but that would be my take. That's what I have to cover with you. As you saw, I reached the end of my slides. So if you have a question, I'm going to hang out here for a minute. Just go ahead and type those questions in the question box, and I'd be glad to try to answer those or relay any comments that you might have for the rest of the group watching today. We will be back again live next week. Pass the word. We have a lot of people attending the Headline Roundup webinar. If you know of somebody that might appreciate the information, we're here to get the message out. So be very glad to send invites to anybody you would like. Thanks, Mark. Appreciate your good work, and we can conclude.